Hello, what's up, everybody? This is Sunko, the Korean bro. Today is 2023, February 18th, and let's start reading stock articles. Okay. Okay, a bull market is coming to perfect growth. Stocks down 60%, 68%, but now and hold forever. Seemingly bad news could be an upside catalyst for the beaten down dividend stock. One number missing from Powell's earnings report. Now should be a market 5 magnificent growth stocks were written up by on the deep. The social Warren Buffett just sent a subtle but terrifying signal to investors. Ohio decided to turn things around near 10-year lows. Okay. A bull market, Atlassian, and Cloudflare. Okay. Two perfect growth stocks that's down 60% and 68% to buy now and hold forever. ASEAN. Okay, is littered in productivity and team collaboration software. Cloudflare is littered in content delivery network software and edge development tools. Content delivery network software. Cloudflare current trade at steep discounts to their historical valuation, which makes now a perfect time to buy. These stocks hold strong competitive positions in quickly growing markets. Investors battled a particularly brutal stock market last year. In fact, three major U.S. financial indexes delivered their worst annual performances since the Great Recession in 2008. The Dow Jones Industrial Average slipped 9%. The broad-based S&P 500 fell 19%. All three indexes have recovered to some degree this year, but the benchmark S&P 500 is still a bear market, and many growth stocks are still trading well below their highs. For instance, shares of Atlassian and Cloudflare are down around 60% and 68% respectively. Of course, not all beaten down stocks are worth buying, but Atlassian and Cloudflare are well positioned to rebound during the next bull market. Here's why now is the perfect time to buy these growth stocks. And let's get to Cloudflare. Okay. A leader in content delivery network software. Content delivery network. Content. Cloud computing company Cloudflare turned in another solid financial report in the fourth quarter. Its customer count climbed 16% to about 162,000. Customer count. While the average customer spent 22% more over the past year, average customer spent more. In turn, fourth quarter revenue rose 42% to $275 million, and cash flow from operating activities soared 92% to $78 million. Those results are particularly impressive in the context of a difficult economic climate. in the context of a particularly difficult economic climate. And the company could likely accelerate growth under more favorable conditions. Looking ahead, the investment thesis is straightforward. Cloudflare provides a broad range of cloud services. They improve the performance and security of business critical applications and IT infrastructure. Performance and security of business critical applications and IT infrastructure while eliminating the cost of on premise network hardware. Eliminate the cost of on premise network. On premise network hardware. Despite tough competition from larger vendors like Amazon Web Services, Cloudflare has strong presence in several cloud verticals, and the company is well positioned to take market share in others. While Cloudflare benefits from two key advantages, speed and scale. Scale, it operates the fastest cloud network and developer platform on the planet. That has led to literacy content delivery network software and edge development platforms, but speed coupled with freemium pricing has also led to meet mind-boggling scale. Cloudflare handles nearly 18% of all internet traffic, and it provides security services to 20% of the web, both of which afford a company unrivaled insight into performance issues and security problems across the internet. Okay. Cloudflare handles nearly 18% of all internet traffic and it provides security services to 20% of the web, both of which afford the company unrivaled insight into performance issues and security problems across the internet. Mm. Cloudflare can use that data to improve its products, creating a network effect that should help it gain momentum in other cloud verticals, especially zero trust security. On that note, Force Research recently recognized Cloudflare as leader in web application firewalls. Web application firewalls. And Gartner recognized the company as leader in web application API protection. So Cloudflare is making inroads in security space. But the company has still only scratched the surface of its $125 billion addressable market, with shares trading around 23 times sales, a bargain compared to a 3-year average of 42 times sales. This stock is worth buying today. So let's summarize a bit. I just read an article about Cloudflare, right? Mm. Cloudflare uh, is a content delivery network company, and its customer has grown a lot recently. And the average customer spend a lot more these days. Uh, what's interesting? about this company is that uh, they accomplished these two things that I just mentioned, especially in difficult economic climate. Mm. Which means when things are getting better, they could um, generate more profits, right? And their cloud services um, is much better than competitor mm, in two sectors: performance and security. Uh, and along with that, they also eliminate the need for on-premise network hardware. Uh, there's a competitor, AWS, but they got more advantage than AWS in speed and scale. Uh, Currently, 18% of internet traffic comes from Cloudflare. Like uh, currently, 20% of the web use security service provided by Cloudflare, and both numbers indicates that Cloudflare uh, can get a lot of data from that service, and that data can be used as a source where they can get insight, and that insight led to web application firewalls, and that web application firewalls um, is like a step for them to enhance security service. Uh, 3 year combined, uh, their sales, hmm, their shares trading around 23 times sales, 3 years, volume compared to the 3 year average of 42 times sales. Hmm. So it's now still worth buying today. And the other company is Atlassian, but I'm just gonna skip at this point because it's not the one that I'm invested. So after burning around $500 million in 2022, Roku commenced profits in 2024, sort of. Roku is growing in important areas in part due to amount of money spending to increase the market share in the growing connectivity space. So Roku is now spending a lot of money on what is it, connected TV space. Part due to amount of money spending to increase the market share. Roku's worse from a profitability standpoint last year. Expenses are going up even more in 2023. Management is putting its foot on the gas, assuming it can overcome its cash burn with much higher revenue in the future. Anyway, they're spending money on connected TV space a lot more. Management plans to spend more to grow the business, makes this a riskier investment than in times past. So, manager of this company spent a lot more on this one, and that lead to risky investment. Okay, there are some incredibly encouraging trends for connected TV's platform, so-called CTV. The company reported financial results for 2022 on February 15, and metrics for active users engagement have never been better. Metrics for active users and engagement have never been better. Roku ended 2022 with over 70 million active accounts, adding about 10 million new accounts during 2022 alone. This led to record amount of video content being streamed, 87.4 billion hours for a year, up almost 20% from 2021. So 70 million active accounts um, These positive trends are important context to keep in mind as we talk about Roku's problems. For me, the problem starts with Roku's net loss of $498 million in 2022. Cash burn problem. Okay, let's see. For those unaware, I'll review Roku's business model. So, what is Roku's business model? The company sells devices that allow any TV to connect to the internet for streaming. They sell devices. Um, to allow any TV to connect to the internet for streaming. It also sells additional hardware devices like speakers and licenses its operating software to smart TV manufacturers. The purpose of these businesses is to simply grow its user base. It's not primarily interested in profits from this part of the business. So, grow users is their main goal, right? Once it attract users, Roku generates revenue from advertising. Hmm. But also makes money in other ways, including when users purchase content through their Roku accounts. Hmm. When they see a brand sponsored home screen, and even when Roku users use a remote control that has dedicated button to particular streaming services. Hmm. This part of the business is Roku's ultimate money making opportunity, not hardware. In theory, sacrificing profits often with hardware should lead to faster user growth, resulting in profitable platform segment revenue for Roku. This part of the investment thesis briefly played out in late 2020 and throughout 2021 before reversing course in 2022, as the chart below shows. Roku's operating expenses were 68% year over year in 2022, compared with only 13% revenue growth. This led to the company's largest annual operating loss ever at $531 million. For perspective, its second worst year was in 2019 with an operating loss of $65 million. 2022 was over 8 times worse. To be fair, research and development expenses and sales and marketing expenses are important for staying ahead of competition and growing a business. Therefore, one might find a silver lining Roku spending. In 2022, spending on research and development was up 71% year over year, and spending on sales and marketing was up 84%. Sharply nonetheless, and 18% of Roku's operating expenses in 2022 were in the form of stock based compensation, which has grown the company share count steadily over the past 5 years. If you are looking for a primary reason why Roku stock is losing to the stock market average over the past 5 years, consider that its share count is up 39% over this time span. Shares purchased 5 years ago represent a significantly smaller percentage of the business today. Path to profits in 2024. To be a little more positive, Roku's management says that it's aiming for profits in 2024. But there is a caveat with Go. The company isn't shooting for positive operating income, but rather positive adjusted earnings before interest, taxes, depreciation, and amortization. You can call this the lowest possible profitability hurdle there is, considering how much it adjusts for. For the record, Roku expects operating expenses to go up more in 2023 and perhaps even 2024 as well. However, it expects speed at which operating expenses are going up to slow down. It expects to overcome higher overall operating expenses with much higher revenue. As a shareholder, I personally believe Roku should be spending to grow its business to an extent. After all, CTV is a big, valuable opportunity. However, I thought that at this scale, it generated $3.1 billion in revenue in 2022. The company would already be producing positive bottom line results. To be clear, I don't necessarily believe Roku is a stock to sell because it's still growing its user base and engagement increasing. Moreover, its advertising technology is potentially game changing. However, by ratcheting up operating expenses to grow more from here, Roku has made itself a riskier investment opportunity. It's going all in on market crushing growth. And now it has delivered. Therefore, Roku stock isn't on my list of highest conviction buys today either. I believe there are stocks with less risk that offer good odds of more market beating performance, but I'll still be holding my shares from here. Okay, what this author says is that Roku is a risky investment because management spend a lot of money these days. Um, a lot of operating expenses are involved, and they're spending too much money on mm, growing its user base. Okay, anyway, to get into it in depth, what they do is they make money from a connected TV space, so-called CTV. Their business model is that they provide device uh, that uh, makes TV connected to internet. Mm. Oh wait, not that's not it. They make device that enables Wi-Fi, and that Wi-Fi allows TV to stream programs. Um, and their strategy is that they first sell devices and they make uh, with that they grow users, and along with that um, they uh, do R&D on advertising. And wait, they grow users and they make money off from advertising, uh, content, and remote control. But then, because they are focused on selling devices first, uh, their net loss is huge because they only focus on operating expenses. But then the good news is that they are aiming for profits in 2024, uh, which is a year from now. So, and that especially in this harsh macroeconomic environment, their user base is so growing, and the user engagement is so strong, and that they do a lot of R&D on advertising technology. So they have good days ahead, but then still it's risky in investment. That's what authors saying. Okay, next one is Allen Key and Power Utilities Kentucky Power Deal Mindful Drew. They could take some. Offshore now has $1 billion worth of loans on its balance sheet. Should investors be worried? External funding is dried out. Offshore has significantly increased the volume of loans it's holding on its balance sheet. The company's cash burn has accelerated. Okay, let's start reading about offshore holdings. Okay, offshore holdings. The artificial intelligence assisted landing technology company, artificial intelligence mm, assisted landing technology recently reported its fourth quarter results, and while the figures beat analyst consensus estimate, they were anything but reassuring. One fact in particular that caught my eyes is that the company now has roughly $1 billion of loans on its balance sheet. Holding debt in this way was never part of the plan under upstart business model, but as capital markets have dried up, it has found itself in a new position. Should investors be worried? They have $1 billion of loans uh, on its balance sheet. Wow, wow, wow. Okay. Why is Upstart holding more loans? While it is common for banks to hold some of the loans they make on their balance sheets, Upstart is not a bank. Yeah, it is not a bank. And management has made it very clear they have no intention of pursuing a bank charter. Rather, Upstart views itself as more of a high growth software as service business and a loan marketplace. Software as a service, right? The goal of this company is to assess would-be borrowers' credit quality, credit quality, and underwrite loans more efficiently than traditional methods, so more non-prime borrowers can access traditional financial products. Upstart's main revenue source is the fees it charges on personal loans facilitated through its platform. So its goal from a revenue standpoint is to generate as much loan volume as possible. Those loans comes from banks and credit unions using their own balance sheets to fund Upstart's loans. Those loans come from banks and credit unions using their own balance sheets to fund Upstart loans, or when the company sources the loans itself and then sell them to institutional investors. As interest rates have soared, funding costs have risen for institutional investors too, leading them to demand loans they yield more so they can still make their desired returns. Meanwhile, credit quality among offshore loans has started to slip as American personal savings have dwindled. And the macroeconomic outlook has worsened. On the company's February 14 earnings call, Upstart Chief Financial Officer Zay Data noted that as we exit 2022 and enter New Year, consumer delinquencies remain elevated. Hmm. And the funding markets remain limited in their appetite for risk. Upstart reported $147 million in revenue in the fourth quarter and a bottom line loss of more than $55 million. For its current quarter, management is only guiding for $100 million in revenue as loan funding continued to be pressured. Cash burn is accelerating. Because funding from external investors and financial institutions has dried up, Upstart has started using its own balance sheet to fund loans. The loan balance on its book has topped $1 billion, up from around $252 million at the end of 2021. The loan balance on its book has topped $1 billion, up from around $252 million at the end of 2021. Meanwhile, the amount of cash in the book has fallen from a nearly $987 million to just over $422 million. Of its roughly $1 billion in loan balance, about $492 million are for what the company refers to as research and development loans, mostly for the auto loan product the company has been testing auto loan product. But the remaining $580 million is for personal loans the company likely couldn't find anyone to purchase due to the recent economic conditions. This adds some risk for Upstart if the macro outlook deteriorates more than expected and loan defaults pile up. The company would have to eat those losses. That would result in burning through more cash than you planned for, and could potentially leave it in dire straits. Data said on the earnings call that Upstart is now roughly the maximum size of balance sheet that we are planning to maintain, and we will therefore largely limit new additions to the balance sheet until we can find suitable sources of liquidity for existing loans. He added that the company will continue to look to sell loans as the market point opens up. With the Federal Reserve easing on the magnitude of its interest rate hikes, companies like Upshot will likely have an easier time selling loans to investors. But the big risk is possibly that conditions in the capital market don't get better. What if high inflation remains persistent? The Fed is forced to raise rates higher than expected or keep them higher for longer. What if the US economy cools too far and slides into recession? That too could lead to an increase in borrower defaults. Hmm. Easier time selling loans to investors. Inflation has shown signs of easing, and the Fed is expected to stop raising interest rates at some point this year. But Offshore currently has more personal loans on its balance sheet than it has cash. Mm. However, unlikely a dire scenario is I have no interest in investing in this stock, which is kind of risk present. So, okay. I just covered Offshore Holdings. The company mainly deals with AI assisted lending technology, and that they have $1 billion of loans in their own balance sheet, which is uh, worrisome for investors. Offshore Holdings is not technically a bank. They're more like advertising themselves as a IT company that provides SaaS, you know, and they are considering themselves as mm, uh, unit that goes into loan marketplace. Mm. Their main products assess would-be borrowers' credit quality and in with uh, automated system. And with that being said, they can mm, give a loan more efficiently. Mm. But then the problem is, uh, you know, if they mm, give loans to more people, uh, the fees that goes along with the transaction increases, and that fee leads to profit. Uh, but then the problem is because of macroeconomic condition, their American personal savings has been decreased, and so in some cases, company were not able to provide loans to people. Hmm. Last transaction, last loan, last fee, and last profit. So if things are not getting better, they be in trouble. Mm. And even well, they have uh, mm, they were able to make some not profit, but like fund from an external investor and like institution. But then because it's been uh, stopped, they're adding it uh, from our own balance sheet. Mm. But then the inflation seems easing these days, so it's gonna get better. Mm. Because it will be easier for people to loan more money, uh, easier time selling loans to investors. Mm. So we'll have to see what's gonna happen, right? So offshore holdings is not safe investment, but it's risky investment because management team spends too much money on R&D. Uh, Not exactly R&D, but then they are like using a business model that's mm, influenced by a macro condition so much. So that's why it's a bit risky, but they still have a lot of potential. That's the point of this article. Wow. Okay, Pound's earnings report. Hmm. Let's look at Pound, right? Hmm. Pound's management team no longer report data on workouts taken on the platform, metric key to understanding user engagement. Hmm. This has to be a sign that this trend is heading in the wrong direction. Shareholders should be skeptical of management commentary about engagement. Okay, something's wrong with Powton. Powton management team. Okay. The exclusion of this value metric is a major red flag for shareholders. In its most recent quarter, Pound Interactive posted revenue of $792.7 million, down 38% year over year. Net loss of 335.4 million compared to a net loss of the prior period. While the bottom line figure was worse than what analysts had hoped for, the sales figure exceeded expectation. Okay, sales increased. It helped push the stock price more than 25% higher following the news. While Paladin reported in several metrics of the exercise equipment making business, there was one important number that was missing from the struggling fitness innovator's latest earnings report. Here's what was missing from the report and why it's so important for investors to understand of the health of the business. Gauge and Paladin's user engagement. While the price jump shows the Paladin's latest financial report was well received by investor, they probably missed the fact that the management team no longer reports one key metric. Hmm. Average monthly workouts per connected fitness subscription. In fact, this was the second straight quarter that the company didn't report this number, and the management team gave no indication during its previous earnings calls that it would stop providing data on workouts. Okay, I covered it too much. Then let's look at the video clip about Upstart Holdings. Okay. It gets a bit complicated, but then what I want to mention is that offshore holdings and Roku, they're both doing some risky investment. Roku, um, management team of Roku is spending too much money, and they're spending too much expense on growing their user base. Um, well, it's not the management team of offshore holdings, but like macro condition is not doing well, mm, for offshore holdings. Mm. If things are getting better, offshore holdings will be good, but then we'll have to see how it goes. Mm. Anyway, this is it for today. I'm gonna have to briefly sum up. Okay, I covered it too much. Anyway, this is it, and I'll see you guys tomorrow. Okay, bye bye.